One of the biggest problem areas I see in many retirement plans is around the utilization of a taxable account, otherwise known as a brokerage or joint account. Now, trust accounts would also fit into this account type as well. Now, although this is a very important account and can be utilized in some incredibly strategic ways, it's also your objectively worst growing account, and I'm going to show you why in this video. Let's dive into some things rarely discussed around these accounts. As a saver and eventual retiree, you have three tax buckets that you can save money into and then eventually spend money out of. Your Roth and traditional accounts are often labeled as retirement accounts and offer a distinct tax advantage, but at different points in the savings cycle. With a Roth IRA, you pay taxes upfront on any money you contribute to this account, but then the money grows tax-free and can be withdrawn tax-free. With a traditional IRA, the tax benefit is flipped. You receive a tax deduction on what you contribute to this account and thus are able to contribute more on a dollar basis. But then you owe taxes when you eventually withdraw from this account. Now, your taxable account is the third option you have, and this option carries a unique benefit, but also some unique drawbacks here as well. With retirement accounts, outside of a few exceptions, the money in these accounts is effectively locked up or constrained until 59 and a half. A taxable account breaks this mold and is completely liquid, and you can access this money really at any time. The trade-off here is you give up a lot of tax benefits that are extremely important in growing this account. Let's compare these three accounts from a pure tax standpoint. In both the Roth and traditional cases, you are just taxed once, but the point you are taxed at changes, either on contribution or withdrawal. With a taxable account, you are often taxed at every step in the process. In order to get money into this account, you pay taxes first and can then contribute the after-tax monies. Then you are taxed on dividends and interest each year during the growth. Then when you withdraw the money, you will likely owe taxes once again based on the gains that you realized. This consistent taxation is the main reason your taxable account will objectively grow your after-tax wealth at a slower rate compared to the retirement account options. A common misconception I see from retirees is believing a taxable account has a unique tax benefit because of lower long-term capital gain rates when withdrawing from this account. For instance, if you're in the 22% bracket, if you withdraw from a traditional IRA, you're going to pay that 22% tax rate on that withdrawal. But if you sell a long-term position in your taxable account, you will pay a more preferred 15% capital gains rate. Therefore, isn't the taxable account better for withdrawals in retirement? This is the wrong question. To make the best retirement decisions, we need to be careful about just focusing on one step in the process like withdrawal taxes, and then extrapolate that out to a broader conclusion like a taxable account is more tax efficient. Let me explain by walking you through this first sneaky growth issue when contributing to a taxable account, and that's contribution taxes. Here we are comparing contributing to a traditional IRA or 401k versus a taxable account. We are contributing $15,000 pre-tax in both cases and are looking at a 22% tax on contribution. We're going to grow both accounts at 6.5% after inflation, which is consistent with long-run stock returns. The growth rate here is less important, however. We could look at a 4% after inflation rate and we'll end up with the same takeaway. Then we are looking at taxing the taxable account at 15% on withdrawal and the IRA at 22% on withdrawal. Now there are two reasons the traditional IRA will win out every time given these general variables. The first is the contribution taxes. When you contribute to a traditional account, you receive a tax deduction, which means you are able to contribute the full $15,000, whereas in the taxable account situation, there is no tax benefit on contribution. You pay the taxes and then contribute whatever is left over, which means in this situation, you're contributing $3,300 less per year. Now, this in and of itself is not a major issue. If we were comparing a Roth to a traditional account, we would see the same gap in contributions per year. Now, the key difference here, however, is the Roth account will never be taxed again, whereas a taxable account breaks up into two key values. You have the overall account value on one hand, but then you have the cost basis on the other. The cost basis is what you've already been taxed on. It's the gap between the account value and the cost basis that you will eventually owe that 15% tax rate on. Given this, by the end of 30 years, the traditional account has almost $1.3 million of gross value, and the taxable account has just over $1 million. Almost a $300,000 difference in value. Then we need to take this one step further and reduce these counts by the withdrawal tax rate we are assuming. We end up with almost $99,000 more of after-tax dollars in the case of the traditional IRA. In fact, you could pay an almost 30% tax rate on withdrawal and still come out ahead with the traditional IRA. In terms of the after-tax return, The traditional IRA grows at a rate of nearly 0.6% more per year. Now, we're looking at 30 years of contributions here, but the longer that you compound for, the bigger this gap will grow. But this isn't the only growth issue here. The closer we get to a real-world example, the bigger this gap will grow. This leads us to issue number 2, taxes on growth. There are 3 times you will owe taxes during growth. Number 1, when you receive dividends. Number 2, when you receive interest. Or number 3, when you turn over the account, like selling fund ABC to instead invest in fund XYZ. Let's assume you are a long-term index investor and there will be no turnover. Now, this alone is a big assumption because it means you're holding the same funds for decades. But I'm trying to give the taxable account the most rosy assumptions here to compare to and then still show there's a gap. Let's focus on the cost of dividends first. Say you have $1 million in a taxable account and $1 million in a traditional IRA. You are invested in an index fund with a 2% dividend yield. Now, a dividend has no tax implications in the IRA because that IRA tax protects those dividends. However, in a taxable account, you owe taxes on those dividends each and every year. At a 15% tax rate, $20,000 in dividends generates $3,000 in taxes, which means you're going to have $3,000 less invested moving forward. Then next year, the same thing will happen, and the year after, and so on. Although this effect seems small negatives compound to much bigger negatives over time. If you are invested in cash or bonds in this account, the effects are even greater. Like dividends, you are taxed on interest each year, but are taxed at income rates rather than capital gain rates. Using the $1 million example here with 5% annual interest, we see that once again, there is no tax effect within the IRA. The interest in this taxable account, however, costs you $11,000 in taxes. This creates an even larger gap in values at year end. Say next year you earn 5% again. This gap is only going to steadily grow each and every year. So let's use the same broad assumptions that we used before in our side-by-side comparison, but the only difference now is that we're going to add a 2% dividend on an annual basis. Early on, when the accounts are small and you're in those early years of contributions, the dividend tax drag will be quite small as well. Nonetheless, over 30 years of contributions, those dividends do add up to have a pretty negative tax impact. On an after-tax basis, the dividends cost you about $20,000 in total value. This lowers your after-tax return by another 0.12%, widening the gap between these two accounts to 0.7% per year. And this is comparing on an all-stock portfolio in both accounts. If you had a 60-40 and we're receiving interest annually, this gap is going to only widen. Okay, so up to this point, we've looked at 2 clear areas of deficiency in a taxable account. But to be as accurate as possible, we need to take one step further and look at the full life cycle. We've looked at contributions, we've looked at growth. Now let's take a look at withdrawals. Now, this is an area of comparison that can grow in complexity quite quickly because we have to ask the question, what's the money for? Are you planning on using the taxable account during your life or just using it as a estate planning tool and passing it on to the next generation? If you use it during your life, we're comparing capital gain rate to income rates, which we'll discuss here in a second. If we are leaving it to the next generation, there's a superb benefit specific to taxable accounts. When you die, your heirs receive a step up in basis, which wipes out the tax liability within this account. Whatever the account value is will be the new cost basis for your heirs. Compare this to a traditional IRA, and there's really only one formula you need to use here. No matter who withdraws the money, you or your heirs, they will owe income tax on that withdrawal. It will always be taxed at the income rates of the withdrawer. The complex variable with IRAs is in your 70s, you will be forced to withdraw from these accounts due to RMDs. And then when you pass this money on to the next generation, there are specific rules called the 10-year rule that your heirs will have to follow and make sure they withdraw the account within those 10 years. But let's say for a second that you are planning to pass the money in these examples on to the next generation. Many might think a taxable account is preferred here, as the step up in basis offers a massive tax benefit that should overcome the growth tax and contribution tax deficiencies. Well, let's compare. After accumulating wealth in both of these accounts, let's say you no longer contribute, but allow these accounts to compound for the next 30 years. Keep in mind, over another 30 years, the growth issues in the taxable account will just keep compounding as well. The taxable account grows to $5.8 million, which would pass on to your heirs completely tax-free, thus giving us the after-tax value without any additional calculations. The IRA in comparison grows to $8.5 million. Now, keep in mind, this wouldn't actually grow to $8.5 million because in this person's 70s, they would be forced to withdraw monies each year because of those pesky RMDs. I excluded this in this calculation because it would simply overcomplicate the scenario and force me to choose additional assumptions. But the commutative property of multiplication tells us that when we pay, the tax rate does not matter. What matters is the rate that we would pay. Given this, if the federal tax rate we pay on withdrawing from the IRA is more than 32%, then the taxable account will win out. Any tax rates paid below this, however, and the IRA wins. This finding was surprising even to me. A 32% effective tax rate on all IRA withdrawals is quite large. To give it a comparison, a married couple who makes $1.5 million in 2024 would have an effective tax rate of 32%. So it's very likely that even with RMDs and then passing an IRA on to the next generation, that you would be able to withdraw at a cheaper tax rate than 32%. So even with using your account as a next generation savings tool, the retirement account still wins out over the long term. Now, let's look at a situation of withdrawing during your life and see if the gap between the two accounts shrinks or even flips, where maybe the taxable account wins out. Here's the situation we are using. We have a single retiree with a 30-year retirement. They have $30,000 coming from Social Security, a $20,000 pension that we'll assume is inflation adjusted, and they need $90,000 of total income to live on. So they will need to pull $40,000 from each account plus whatever the tax liability would be. Now for this situation, we're going to use the actual taxes this retiree would owe based on 2024 tax rates. Remember, our growth rate, pension, and Social Security are all inflation adjusted. So we don't need to factor in inflation increases on the income need each and every year. To reach $90,000 of income, you would have to withdraw approximately $54,000 from your IRA because those IRA tax liabilities will be $13,700. Note down below that the effective tax rate we pay based on just our IRA income will be higher than the rate we were assuming before. I'll talk about why this is the case in just one second. Taxes will be lower with the taxable account because a portion of our capital gains will be taxed at 0%. Here we owe $4,700, which means we need to withdraw about $45,000 from this account. And again, here our effective tax rate on our capital gain is lower than we were assuming before at only 10.4%, whereas again, we were assuming 15% before. Now, you might be thinking, why is the tax rate on the IRA income so much larger than we previously would have guessed? Well, this is the tax graph we are facing before withdrawing $54,000 of IRA income. As we talked about numerous times on this channel, certain income streams like Social Security completely change your tax graph, creating something called the Social Security tax torpedo that you can learn a little bit more about in the video in the right-hand corner here. But as you can see, all withdrawals are taxed at least 22%, with a portion of withdrawals seeing a 40.7% marginal zone. Again, this means the taxation of the IRA withdrawals is a bit higher than we previously assumed. Well, this begs the question. If we are underassuming our tax rate on IRA withdrawals and overassuming it on capital gain withdrawals, will this be enough to close the gap we were talking about before? Well, let's take a look at what the numbers say. We are building on the same situation we have already been using, but are now simply taking out withdrawals that we just calculated we needed and are doing that annually over a 30-year period. Again, there are going to be some more complex variables that I'm leaving out here, like RMDs, other tax hurdles like IRMA, or in the case of a taxable account, as the account value goes up relative to the cost basis, the contribution will need to rise to factor in the added taxes from realizing more growth annually. But in general, as we add withdrawals to this situation, interestingly enough, the gap between the accounts actually grows on a percentage basis. The IRA here wins out if they can withdraw at a tax rate less than 38% after passing away, which again is extremely likely. Now you might be scratching your head. We withdraw more in the traditional IRA situation. How does the gap between these two accounts become larger than the no withdrawal situation, again, based on a percentage basis? Well, even though the dollar amount withdrawal is larger in the IRA situation, the withdrawal rate as a percentage of the account is smaller because the IRA has a bigger account value. In the taxable account situation, the starting withdrawal rate was about 4.7% and only 4.1% in the IRA situation. So ongoing withdrawals actually further the gap here rather than shrink it. So let's quickly summarize what we just went through here. Unless we are using some very specific variables or using a fairly unique situation, a retirement account is going to objectively be a better account to save into versus a taxable account. And the main reason for this is taxes. A taxable account is just too leaky of a bucket. Now, this video might make you think, I hate taxable accounts, and far from it. I actually have the majority of my personal liquid wealth in taxable accounts because of maxing out other accounts. I think taxable accounts are great, But I think it's crucial to know what you are gaining and what you are giving up by investing in this account type. The main case for a taxable account is ultimately liquidity. And depending on your goals, this can be the most important variable to focus on. For instance, let's say you're 50 and this is your situation. You have small savings in a taxable account, but most of your wealth is in retirement accounts. Now, you may have enough wealth on paper to retire, but the problem is you can't easily access that wealth. Sure, you could use something like a 72T to gain early access to the IRA, but this is not without complexity and constraint. So this specific retiree would have benefited far more from focusing on liquidity in their savings goal versus tax benefits. Now, it's also worth noting that liquidity has its drawbacks too. It's like having cookies in your pantry when you are on a diet. You are placing all of your marbles in the discipline camp, which fails long-term for most people. Say you're in your 40s and have $500,000 saved in a taxable account, planning for an early retirement in your 50s. You are on track for this goal, but then you and your spouse are talking and thinking it'd be great to renovate your outdoor living space and also upgrade the car. Well, you have $500,000 you can tap into in order to make those purchases. Now, maybe these two upgrades improve your life enough that they are worthy purchases in terms of taking a step back in those retirement goals. But if that money was locked up, you would be forced to find another means for those purchases or forego them altogether. I frequently see with young investors the difficulty of keeping the money in their taxable account invested for the long run. So in that way, liquidity becomes a bug rather than a feature. I hope this breakdown between taxable and retirement accounts was helpful and aided you in making better decisions moving forward. Were there any variables you think I missed or maybe you still have questions on? Put them in the comments below. If you're looking to learn more about how you can build a more tax-efficient taxable account that really minimizes the tax drags we discussed in this video, click here to learn about the 5 important rules you should follow with this specific account. Click here to learn more, and always remember, you don't need more money, you need a better plan. I look forward to seeing you in the next video.